Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our friends at Strategas. Today, I'm thrilled to be joined by Thomas DiFazio. Thomas is a director on the firm's asset allocation team. Thomas, how are you doing today?
I'm great, Ross. It's great to be here. How are you?
Yeah, I'm doing well. Great to talk to you. The way I think about your all's sector allocation and asset allocation work is all of the research you do, it kind of ends there. How are you putting the money to work into action based on the research that you've done? And so I want to talk to you all today about that effort. But I thought maybe a way to go through it would be to talk to you about a few of the things you're looking at, any indicators, any things that inform your all's decision making. So maybe we could start with, something there that you're looking at right now.
Absolutely. Every single month when we're taking a look at our asset allocation, we try to look for signals that help us get more constructive or help us get more negative and where we may be offsides. One of our indicators that's been most helpful so far this year has been a price indicator. We've been closely following the percent of stocks that have their 50-day moving average above their 200-day moving average, or how many stocks are in an uptrend. Broadly speaking, most sectors year to date have seen an improvement in their percent of stocks that are in an uptrend, with the exception being communications, which is flat, and then energy, which has seen a contraction so far. But here's the good news. You actually do not need to be a leader in order to participate. Take the defensive sectors, for example. You have seen consumer staples and utilities seen their percent of stocks and uptrends improve. And I'd also just mention, you don't need to just, another example could be the Russell 2000, the small cap contingent of the sector, of the overall market. They've consolidated a very sharp move going into 2024, and they did it on a very healthy basis. They didn't go down, they went sideways. And that kind of participation is very important, and you don't need to outperform in order to help the market move forward from here.
Yeah, it's something that I've seen you all write about, kind of momentum begets momentum. This everything rally and some of the thrust we've seen over the last 3 or 4 months is very, kind of bullish over the intermediate term. So that's one that would obviously be kind of incrementally positive at this point. On the fixed income side, on the credit side, do you all look at credit spreads or the health in the bond market as an indicator for how you're feeling about the equity side of things?
We certainly do. Our fixed income strategist has been great to help keep us honest. But overall, we have not seen any stress within credit so far this year. We used the NYCB event as a way to help see if there was something more sinister going on underneath the surface or if there was any sort of contagion effect. But so far, we have not seen any stress there. If we start to see some stress within credit spreads and those spreads start to widen, we'll then start to get a little bit more concerned and begin to wonder, are we missing something? And that would warrant more attention and then probably lead us to get a little bit more cautious.
Yeah, definitely worth keeping an eye on credit spreads, which again is the yield of a corporate security over a treasury to just get a sense of borrowing costs and whether there is that strain in the system. I want to end with one more. I've heard you all say before the building blocks of the market, interest rates and earnings, corporate fundamentals. You kind of have to come back to at a certain point. How do you all look at corporate fundamentals? What lens you use there to get a sense of where the healthy parts of the market are versus maybe some of the weaker parts?
Yeah. We have a favorite of ours that really just think of it as an earnings breath for the overall market. So we look at every single sub-industry within the US market, and we look at their earnings growth on an NTM basis and then a TTM basis, forward versus trailing. As of right now, we are seeing those series diverge. The NTM series has picked up, and you've seen an uptick in the amount of sub-industries that are seeing positive earnings growth, but the TTM series has remained low. So there's a little bit of a divergence going on. Going forward, we would like to see the TTM series start to follow suit with the NTM series and hook higher. That divergence has our attention. What could make us get a little bit more cautious is if the NTM series rolls back over because the TTM earnings breath did not confirm that move. As a whole, that is a wait and see. So for right now in March, we're going to be remaining unchanged across equities, fixed income, cash, and alternatives. And we're going to wait for more new information to come to the surface.
Yeah, there's a lot of optimism right now, expectations for earnings growth. But as of yet, they're just expectations. You still need to see that confirmed with actual results. So a good thing to keep our eye on. And I would say for everyone who might be watching, Strategas' sector and asset allocation work is available on bairdwealth.com. It is client approved for our Baird clients. So take a look at that if you want to get a better sense of what Thomas and the team are doing. Thomas, thank you so much for the time as always, and hope to get a chance to talk to you again soon.
Thanks for having me, Ross. It was great to be here.